Hi, welcome to the Guaranteed Retirement Guys show. So today we're going to be talking about how to protect your retirement with an annuity. So I'm going to share my screen here in just a couple minutes, but I just wanted to talk a little bit about this because you've worked your whole life to build up this nest egg. Okay, maybe it's in a 401k, maybe it's in a 403b if you're a teacher. Okay, maybe it's a TSP account if you're a government worker. Okay, wherever it is, your money has been building over the years and you're trying to protect it. And you're thinking about annuities, but you're not sure. You talk to maybe some of your friends and some of them say, well, don't do it. There's surrender charges or you're not going to make as much as the market. And they're right. There are surrender charges if you are to surrender any of these contracts early. But there's significant benefits as well. And of course, there's some significant growth that you can get. And of course, they protect your retirement against any type of market downswing. Okay, so I'm going to share my screen and actually show you how these work and how you can protect your hard-earned retirement funds from any type of market downturn, recession. They're virtually recession-proof. Okay, all right. So I'm sharing my screen and I am looking at indexed annuities. Okay, and you might be, maybe you know a little bit about indexed annuities. Maybe you don't. Okay, indexed annuities work, but they have to be set up properly. Okay, there's a lot of indexes out there that are very, very fancy, and sometimes they're a play off of an index that you might know very, very well. But the actual index performance is back tested only for a couple of years. Okay, and when I look at those, I usually don't ever recommend putting your money into that unless you just want to gamble, unless you're just thinking, hey, maybe this index will pay off and it'll be great. But fair warning, there are a lot of back-tested returns out there. So with this, I'm only looking at the S&P 500 because I want to give you some actual results that you're going to have a high likelihood of getting. Okay. All right. So what I did, the only thing that I changed here, you notice what I did is I put a 55-year-old and I put $500,000. The only thing that I changed in the filter was S&P 500. Okay. So I wanted to make sure that we have the S&P 500, the actual index. And again, when you're thinking about protecting your retirement with an annuity, well, how do you get index returns without having the losses? It's really very simple. The insurance company purchases call options associated with the index. Okay. So in this case, it's the S&P 500 index. And so what they're doing is they're purchasing call options and they're putting a cap. And you'll notice for this one, they're capping it at 15%. They can change that each year, so keep that in mind. But this particular company, National Life Group, they tend to keep their caps pretty high. So a cap is just basically what they're limiting what you can make during a good year. And of course, in return, while the market is going down, instead of having any losses, you have zero losses because they're not exercising those call options. So it's pretty significant if you're looking for safety, especially during a recession. You think about the housing crash. That was a huge recession. People in these contracts didn't lose a dime because of how they were structured. Okay, so I'm going to illustrate this and I want to actually show you what this could look like. Now, again, these are hypothetical returns, so keep that in mind. But I'm going to look at, let's see here. Let's go down to, let's talk about the first one, okay? Guaranteed values. You notice here it has it going down. Why is it going down? It's because they have a rider charge. You don't have to have a rider charge on here, okay? So we could take out all charges. So just so you know, but they're giving you some extra growth based off of this. So let's look at this here. And they're actually giving you an income value as well. So let's look at the hypothetical. Hypothetical is, well, it's pretty wild, okay? You can see these numbers here. It can grow by the time, let's say you put it in 55 and you just let it sit for 10 years, it can grow to what? Almost $1.5 million. Well, that's pretty good. You can see during the years where the market's down, you're not getting any interest, but you're not losing a dime either, okay? But let's kind of dumb this down a little bit because some of these numbers are pretty high and a lot of guys will try to sell these things and make these huge commissions based off of assumptions. And I'd rather take those away and make this as real as possible. Okay. So I'm going to go back here and I'm going to say, I don't want any fees. Okay. No fees, nothing. Okay. Now, again, you'll notice I'll go to this one. It says 15% cap on the S&P. See what that looks like. So it's showing us a rider fee. I don't want that. Let me go back here. I don't want any fee whatsoever. That one has a fee. Well, you can do it without a fee. For some reason, it's not going to show up. So I'm going to go here and see if this one will show it. Okay. So this is what it looks like without a fee. And it's the same thing with National Life Group. What we'll have to do is we'll look at a different illustration. When you book a call and you want to talk about protecting your retirement with an annuity, we'll actually log into some of these carriers and we'll take that fee out manually so you can see exactly what it looks like for real growth. Okay, real growth without any of the fees. All right, so again, if you look at a guaranteed values is that the index does nothing, then it's just going to stay where it is. Okay. If we look at a hypothetical, and this is a different type of option. This is a point-to-point for 5 years. It's measuring 5 years. So it's measuring the S&P index for 5 years, which, it's not bad. 5 years, 37%, that's not bad. It's not that great either, but it's the 95%, that's based off of huge growth over 5 years. But again, when we look at that 10 years, you can see the growth. Well, let's say after 10 years, it's 1.347. So that's not too bad, but I would still caution you on the conservative side. Maybe take this number of 1.3 and just maybe drop it down a little bit to like 900,000. That might be a little bit more conservative, but at least for illustration purposes, you'll be say, all right, well, if I land anywhere between 900 grand and 1.4 million, I'll be happy. Okay. And so just take this with a grain of salt. When you're looking at these illustrations, keep in mind that the caps do change. Okay, they do change at the end of each point to point. If you want to lock it in for a longer period, you can. Just remember though, it's going to measure a larger time frame, and if you have the market upswing during that time frame and downswing, it could cause you to have zero returns. Okay, so I usually like to spread it out, 1 year increments, so you actually have more compounding periods. But this is a way to protect your retirement from any sort of market downswing. Now, you might be thinking, well, I need income from this, John. I don't want to just build this up for nothing. Okay. Well, if you're looking for income, then what we need to do is we can look at annuities that will protect it. Okay. But the account balance itself, it's not going to stick around forever. So let me show you that. We'll go here and we'll say age, let's see, we'll change the state. We'll say Pennsylvania. Okay, and most of these annuity contracts are available every single state. Okay, they're very, very small variations. So we'll say 55, and then spouse is 55. Okay, all right, and let's say we defer income until we are 65. Okay, now this is going to show us, and I don't want any reduction here, so I'm going to click this box right here, and we'll see what this looks like. So, all right, 55 years old, spouse is 55, $500,000. We let it sit for 10 years, and then we take lifetime income. You can see Midland is the highest, followed by North American, followed by Emeritus. Okay, so $68,600 is the highest you can get guaranteed for the rest of your life. Now, if you look at the account value, though, the account value is not going to stick around. Okay, so keep that in mind for income annuities. Okay, if you look at the account value and with zero growth of the index, which is the extreme side, they're showing you the account value here will go down pretty drastically by the time you're 70. Okay, because again, they're taking the fees out. You see the rider charges right here? $6,200 a year. And they're charging you, but they're taking it out of the account. So that's what gives you this high income. You don't have to have the charges. You can take the charges away, but your income will go down by like a third. So usually people want it because they don't want to have, they'd rather have $68,000 a year than $40,000 a year. And the only reason why you don't want the rider charge is because you want to leave the money behind to someone else. And that's fine too. But most people, they'll set up separate accounts for legacy and they'll set up these accounts for income. Okay. So, all right. So let's look at the hypothetical. Okay. So if we have okay growth, the account balance is still going to go down. It's just lasts a little bit longer. So I'm going to go up here and say, well, what can the top 3 allocations make me? Well, it's not a huge average, but let's see what that would do. If those actual returns materialized over that time period, would my account value last any longer? Well, let's look. Yeah, it lasts like 4 or 5 years longer. So by the time you're 80, it's at 0. So again, the income though never changes. Okay, that's what's so beautiful about these contracts. It's a guaranteed contract of income. For $500,000, it's going to guarantee you at age 65, $68,600 for the rest of your life and your spouse's life. Okay. If you take that money out until you're 95, you've taken out $2.1 million. Okay. That's substantial. That's what you're getting. That's how you protect your retirement. And that's how you do it with an annuity. Okay. There's so many variations of annuities. Okay. If you're looking for growth and you want to protect your principal, we've got annuities for that. Okay. If you're looking for just highest income and also protection of your money, even when the market crashes, okay, we've got annuities for that. Okay. It really depends on what you're looking for. Most people who reach out to me, they want the highest income. And if you want the highest income, it is the fixed index annuity with the income rider. Okay. And there's an easy way to do it too. If you want to go to my website, johnstevenson.com, I've got annuity calculators there. Just go to the income rider one, put in your information, and it'll show you all the top paying annuities. Okay. It takes about 2 minutes. Okay. And it'll show you everything. So, and if you want to book a call, there is a link below this video. There's links on my website, and you can reach out to me that way as well. But I'd love to help you, okay? If you're looking for annuities or if you got questions, please book a call. I won't try to sell you anything, but I will show you everything that's available. So it doesn't matter what I'm getting paid, okay? If my commission is low for the highest paying annuity, I'm going to show it to you, okay? I'm going to show you everything that's available so that at least you can make the most informed decision. So anyways, I appreciate you watching. I know this video was a little long, but I really wanted just to dive into the different ways that you can protect your retirement with an annuity for growth-oriented investors, as well as most of us who want to retire with lots of guaranteed income for the income rider annuity. That is usually the best option. So again, thanks for watching. If you like it, please click on the like button, okay? Make sure you subscribe so you get all of my awesome content each week, and make sure you share it. If you got other people that can benefit from this, share the video. It'll help them out. And of course, if you want to book a call and you want to talk some more, please feel free to do so. So thanks again for watching, and we'll see you next time.